And we are live.
Hello there.
Hello.
How's life in Seattle?
Oh,
Third of the way across the world, but very similar to London a lot of the time. It seems like, you travel a long way to be the same. Different time zone, same weather.
Certainly. Yeah.
Funny.
Well, we're doing a unpublicized pod this morning and live streaming it. You've got family matters to attend to this weekend, so we thought we would do a live and record our session on this beautiful Friday morning. So, hey, everybody, if you're watching us live, if you happen to be up early West Coast time or have nothing better to do on a Friday afternoon in London,
nothing better to do than join us. Yeah. Listen, what could be finer, than to listen to a podcast about microeconomics and how it applies to e-commerce. Personally, I'm a massive nerd, so I actually would find it hard to think of something finer in the business arena anyway. So yeah, I'm genuinely pretty up for this. I think we're both pretty excited about the microeconomics thing, aren't we? Because a few weeks ago, well, even 2-3 weeks ago, we were talking about this, and you were saying I've been deep diving into this. I'm like, oh, this is heaven for me. I love this stuff.
Yeah.
And there's so many rewards to be had from getting this stuff. I really am a massive believer in this for e-commerce sellers.
Yeah, totally agree.
It's great stream of stuff to be doing for sure.
We're calling it our e-commerce first principles series. And so we kicked it off last week, I guess, or week before last, last session. And this one, we're going to have a great conversation about a rather odd phrase that most people haven't heard of, but of course they understand the concept. And we're going to geek out over it a little bit together today. And that's asymmetrical risk and reward. Yeah. And so I'm really excited about this one. I know you are too.
Yeah.
This was your top topic when it comes to e-commerce first principles. And this is not going to be sterile. It's not going to be academic. There is real world implication for asymmetrical risk reward for e-commerce sellers that is 100%. Very practical for people to understand and really, really, I think, help people evaluate their opportunities in e-commerce. So if you're interested in this idea of managing your risk, understanding your risk, and reward and payoff, then this session is going to be great for you, I think. So
absolutely. Yeah, the word risk is something that people always hate, but the reward is nice. So we're actually being brave and using both words, which is in itself, it shouldn't be rocket science to use the word risk in relation to business and entrepreneurship. Mm-hmm. But because it's unattractive and doesn't sell courses, it's actually not often talked about. I think it needs to be dealt with front and center as part of our business strategy. And we've talked about business model defensibility, which is kind of related, but it's not quite the same sort of look at things. It's a slightly different lens through which to look at things. So yeah, I think it's really critical stuff.
Well, we are going to kick things off here. If you're watching with us live, welcome, and give us a comment or a like or whatever in Facebook if that's where you're watching, and let us know where you're watching from. And then if you have questions throughout this podcast, we're happy to entertain them. We're going to record officially in a moment for the podcast episode, but then we'll stay on after we're done with the recording and answer questions and do a few housekeeping things like that. So that's sort of the format we'll work through. So feel free to leave comments, say hello, give us your thoughts and ideas as we go from through this idea of asymmetrical risk and even examples. This is a concept that is most interestingly talked about through examples, in my opinion. And I've got a couple fun ones. Michael's going to kick our podcast off with a reading from a fun story, and I think that'll be a great intro to it all. So are we ready to do this, sir?
Yeah, as ready as we're going to be. I mean, the thing is that I was fairly brief preparation for this actual podcast, but I've been obsessing about this concept for some time. So hopefully it's in the brain, ready to roll out there. So yes, story time with Mike will be starting in a second. So I guess are we going to kick the actual? Are you going to give a quick intro and then I kick the podcast off with a story?
Sure, let's do
Excellent.
that. Yeah,
over to you then.
All right, let's do it. Here we go. We're going to kick off our podcast, and I'll start it off. Hey, everybody. Welcome to the E-Commerce Leader Podcast. In today's conversation, we are going to do a deep dive on asymmetrical risk and reward. It's part of our e-commerce first principles conversations, and we're really excited to share this concept with you. We're going to start a little differently today with a reading by my man, Michael Veazey. Michael, are you ready to share this fun story?
Story time. It's very sweet that when you want to start things off with a story, you're like, oh, can we have a story? I love your enthusiasm. And actually, as a marketing or even learning tool, stories is probably underused, even though everyone
Yes.
theoretically knows it. So this is a story from George Glasson's famous book, The Richest Man in Babylon. Quite a short book, much quoted, some wisdom in there, sometimes misunderstood. But this is an interesting one, set in sort of Babylonian times. So a merchant is trapped outside the city walls because it's nighttime. It would be morning before the gates of the city would open. The merchant had just come back from selling his wares and had quite a hefty amount of gold coins on him, as you do if you're a successful merchant. As he began to light his bonfire to the camp outside, he began to hear the bleating of a flock of sheep. Another merchant, a sheep master, had arrived with his flock. They made their introductions, and the sheep master mentioned he lived nearby and he wanted to sell his sheep for a good price in the morning. Suddenly, a house servant of the sheep master arrived and with bated breath warned his master that one of his sons was gravely injured in an accident. The sheep master was extremely worried and told the merchant he would sell all of the sheep at a discounted price so he could hurry home to his son. The sheep master mentioned he had over 200 sheep with him. The merchant's gold was just enough to cover the purchase price for all of the sheep, and the merchant knew from his experience that the other merchants in the city would pay at least twice the amount for 200 sheep, but there was no way to confirm this as it was too dark to count the sheep. The merchant was presented with an asymmetrical risk. As you can see, the flock of sheep there. The reward was he can make a quick profit by buying the sheep cheaply and selling them in the city for a higher price. The risk was that the old man might be lying to him and there were only 100 or 50 sheep in the flock. The merchant in the story ended up not buying the sheep. So the old man decided to hurry home, left his servant there to sell the sheep in the morning. The next morning, when the gates opened, other merchants came out and bid up the price of the sheep to 4 times the amount of gold the sheep master offered to the merchant. The first merchant had lost his chance to profit greatly because he did not take the asymmetrical risk.
Ah, a wonderful tale from ancient times that points out asymmetrical risk is critical. Ancient times from the 1950s when he wrote that story.
Yeah, 1920s, I think. The Richest Man in Babylon, pretty old, yeah.
So let's just walk through that story for a moment and use it as a framework for understanding asymmetrical risk reward. And I'll just mention that Wikipedia defines asymmetrical risk as the concept of taking a risk that will produce a return that's far surpasses the concept of taking a risk that will produce a return that far surpasses the risk taken. This is the core concept, that you want to have an outsized return and a very capped risk.
Mm-hmm.
And so in that story, the guy was presented, he was on the horns of a dilemma there. He had the potential for a big payoff in just whatever it was, 6 hours or 8 hours. But he had to trust that the old man wasn't lying to him. So the risk was he was being duped, being lied to, and the reward was this potential for doubling his money overnight.
Yeah.
But if he gave up all his money and he was being lied to, he could lose a lot of his money.
Yeah.
Right. And so that was the situation he was presented with. This is the basis of every Ponzi scheme and kind of grifter, greed kind of shenanigan you get sucked into, right?
Yeah.
Huge upside, quick, right?
Exactly. I mean, I would say I wouldn't necessarily say that the decision. I'm not a game theory expert, and I haven't sort of fully played out the implications because we don't really know quite enough information. And that's what the first thing is. Working with incomplete information is an interesting concept that is implied by this, first of all.
Mm-hmm.
Now, that's not quite the same thing as risk reward. It's like two Venn diagrams. They cross over.
Yeah.
I would say the ability to handle somewhat incomplete information and make a decision and a risk reward as part of that decision is really important. This is rather severely incomplete information. And I would say that in this concept, if I understood the merchant's assessment of the situation was, if he's lying about the sheep, I could be massively overpaying. However, I could double my money in the morning. So if you could lose all your money or double it, that's not actually very asymmetric in my mind anyway. Whereas if his assessment had been what happened in the future, which was that they sold for 4 times the usual price. Okay, I could lose 100% of my investment, or I could end up with a 400% return. that would have been an asymmetric risk reward.
Yes.
So that's the first thing. The second thing to say is this, and this is a really critical point, because there's a Medium article this comes from, and I think we should link to this, because there are some, I think, errors of thinking, if I may say so, that I think are really worth reflecting on. The first thing is this: hindsight is 2020 vision. Knowing, as he quotes, for example, as in 2021, early 2021, when recording this, that Amazon is actually blown up, as e-commerce blew up, and etc. If you knew that back in 1999, it would have made sense to invest in a company that looked like it was on the verge of bankruptcy and was part of the dot-com bust and all that stuff. But that's not how we we don't have time machines. So that's an incorrect way of looking at the past, because what the merchant was doing in the middle of the night, maybe very tired, maybe scared, was making a decision at that point based on the little information he had of the risk reward ratio. So I think that's an important thing to say, that we only make those decisions as we go along, and it's only retrospect that we see whether they're correct or not. But that's the retrospect, the history. Hindsight is for historians and business historians. As business operators, we need to be able to make decisions in real time about the near future. So that's what strikes me.
I take your point completely. Asymmetrical risk reward is got fascinating examples, and a very boring example, in my view, is putting $1,000 in Amazon stock in 2001 and waiting for 20 years. That's not really an interesting example of asymmetrical risk reward, because there's two components of asymmetrical risk reward that are super important in my view. One is money, the other is time. And it's the combination of those two elements that make such a fascination out of this concept of asymmetrical risk reward. Because we all know, I mean, we've all done things that are good, investments. Hopefully, I mean, we bought our house 20 years ago, or we, invested in Amazon in 2001, or I was early in Shopify investing. That's my best holding, to be completely candid.
Of course.
And it's, but those are boring examples because they're not really that interesting. I think the more interesting example is when you're presented with an opportunity and you have to do calculation as to whether this is a good idea or bad idea for me and my business right now.
Yes.
And those examples, I think, are really, they spark our imagination and interest and really get our minds working overtime to figure out, is this a good idea or bad idea for an input of either my time or my money? So I think that's kind of the dynamic there. I do think investing in the stock market over time is asymmetrical risk reward. It's just boring, and it takes a long time to play out. It's my 2 cents on it. So So what should we do here? You want to do some examples, or you want to keep going? Keep going.
Yeah, I think examples are good, but I think defining terms is always good. Maybe I'm just too sort of old school, classical guy, but maybe it's British training. I don't know. But I think the first thing is, I think it's worth digging into, because asymmetric risk reward implies, okay, we'll leave asymmetric to one side. Let's talk about risk reward and define what do we even mean. So I think it's important to be simple and yet clear. And like, these things can get very complex very quickly. But Warren Buffett, who's obviously super sophisticated investor, said that risk is simply the probability of something happening times how bad it would be. And I think those are two different concepts. So the risk itself, how big is it, times the probability of it happening, and reward is the flip side, how big is the downside risk, as people call it sometimes. And then the reward side is how big the upside is, as some people call it in the investment world. And I think we would do well to think in those terms in business world as well, and operators of businesses, times how probable it is. And I think those are separate concepts we have to tease out for ourselves, really. But the size of the downside is, I think, considerably overlooked a great deal by a lot of e-commerce operators, because it really doesn't make sense to take a downside risk that will kind of completely wipe you out, even if the probability is 1%, versus a rather crappy upside potential. Excuse my French, sorry. Going back to British ways of direct speaking here. And I think that's really very, very everyday thing that we need to change our mindset about, which can completely transform the safety of your business, the sellability of your business, and the security of your future income, if you're going to keep it for the rest of your life as well.
Well, let's talk about your Warren Buffett example for a moment, because his whole entire investing career has hinged on the idea, once he got into it, of using float from insurance companies. And calculations related to what he calls the super category event, insurance, claims, like a category 5 hurricane, or that kind of massive earthquake or something like that. His whole business is predicated upon the fact, if this is really interesting, asymmetrical risk, that he takes a very, I mean, he uses math to safeguard himself, but here's what he's doing. He's taken, let's say, $100 a month from somebody in California. And so in month 3, he's got $300. But the risk he's taking is if he insures their house against a fire, a $600,000 house could burn down. So his risk in that conversation is really interesting. And so, the insurance companies are really mastering this concept, and they create a situation which they only collect premiums in a sufficient way as to safeguard themselves so that they, can survive and thrive for the long term. And they're basically, playing in that space of asymmetrical risk reward all the time. And because if you look at it on face value, they obviously, as a group, take some real losses. They do take somebody's insurance for 2 months, and then the house burns down.
Yeah.
But on the whole, they know best how to manage their risk and have actuarials that really understand the science of large numbers and factoring those things in. So anyway, that's just that's his context in which he's bringing those phrases to the party. I think is important to understand what he's doing there. And of course, the benefit to him is he gets all of that money from all of those monthly payments, and that's called float in insurance business. And he gets to use that to invest. And that's how he became massively rich. He became a billionaire at 58 because he mastered the art of buying insurance companies and managing their float with precision investments in wise, stocks and buying companies. So anyway, it's a fun little example to think
It
about.
is. I mean, what would be interesting to me is I'm not quite sure. I mean, I don't know enough about the insurance industry, although weirdly enough, because of where I live in Hampstead, it's just absolutely full of city people. So like the city of London is not just London, it's a specific 1 square mile, which is full of financial geniuses like Wall Street. And the guy opposite, he lives opposite, I happened to talk to him this morning. He's an actuary by training. So he assesses life's risk, which is kind of interesting because we've got a 94-year-old neighbor and he there's COVID knocking around. So we have some pretty dark conversations with him. He's pretty based on the numbers, not so much humanity. And then also we've got a family member who's actually CEO of an insurance company, which right now is a horrendous thing to be. So I'm not sure that in the end, when an insurance company gets it right, it's really very asymmetric. It's somewhat asymmetric because that's their profit or loss. It's a tiny bit asymmetric, I guess, but really I think it's about accurate risk reward there in that kind of, but you're right. The ability of an actuarial way of thinking is, I think, really underestimated with, if you have a spread of products, like if you have 200 private label products on Amazon, the probability of some of them not working and some of them working across the spread of big numbers is actually the sorts of way that I think you've got to think much more than most people do. So that's one of the reasons I think it's relevant. I just want to give you one example of an asymmetric risk reward that people take all the time, which is sadly a bad one. It's asymmetric, but it's mostly the risk of Amazon account suspension versus an upside, and that is when people ask for reviews in terms of in return for some money or some kind of incentive. And people still teach this stuff on Facebook, so they still ask it. It blows my mind. I'm like, it's 2021. This has been a seriously suicidal thing to do, but that's an example of where the upside potential is a review, which may help maintain your conversion percentage and make the economics work. The downside potential is your entire, maybe hundreds of thousands of dollars worth of revenue is cut off midstream. And actually, what's the probability of that happening? Well, it's actually quite high because they really take this seriously. And therefore, it's a horrendous asymmetric risk reward that you're entering into. And people make that trade, not intelligent people, but mediocre people on Amazon who don't know what they're doing, make that trade every day of the week. And that's just one very, very small example that through the lens of risk reward, it looks absolutely insane. And through other lenses, it doesn't. And that's why it's a lens one has to use, I think.
Well, so just to unpack your example a tiny bit, let's just say you have a 7-figure business on Amazon. Any risk you take related to violating an Amazon term of service puts your 7-figure business at risk of being completely closed.
Yeah.
So, I mean, that's, I mean, at the heart of it, any TOS violation. Now, sometimes people's Amazon accounts get shut down for completely benign reasons. And
Yeah.
generally speaking, in that situation, you can get things patched up and fixed quickly. And, I mean, there's resolution process there.
Mm,
But to your point, taking unnecessary risks for
mm.
small, reward is unwise. And Warren Buffett's famous quote, I'll butcher it a little bit, but he basically said, to get what they didn't need, they risked what they did need. And that is insanity.
Yeah. I would love
And
that quote. Yeah,
something to
another
the
one.
effect
Yeah.
of that is his
Yeah,
quote on
yeah,
this. Yep.
absolutely. And the other thing to say is this, that if you're going to take, I mean, effectively, it's interesting comparing what I was talking about with Amazon with what you were saying about Warren Buffett and the insurance quote, because actually they got $300 in the bank in month 3 of collecting the premiums for the house,
Yeah.
and their downside potential is $60,000. But the reason that
600 maybe.
works,
Yeah,
it
whatever.
was 600,000. Sorry,
Yeah.
yeah. So,
Yeah.
um, but the point is, they are very, very meticulous about calculating that, and they have the law of numbers on their side. If
Yeah.
you bought one house on that basis, or you insured one house, you'd be taking a big risk. And this is another thing that is counterintuitive. A small business with not many SKUs is a very risky thing, because every single SKU, if you try and sell a business that's doing, for, I don't know, $100,000 or something to some buyer or aggregator, because I talk to a lot of aggregators at the moment, and he said, yeah, think about it, it's common sense. If you've got one business that 50% of the revenue comes from one product,
Yeah.
there's a really huge asymmetric risk attached to that, compared to a business that has 100 products, where if any given one of them gets taken down, it's not so risky. So there's a law of large numbers that kind of mitigates risk, when if you insured one house, you'd probably be taking a much bigger risk than insured 10,000 houses.
Yeah.
So that's another interesting thing, right? I mean, it gets very deep waters very quickly, actually.
Well, yeah, for e-commerce sellers, it does imply a portfolio business is wiser than a single product business.
Yeah.
An omni-channel business is wiser than a single channel business.
Yeah.
Although I
Yeah.
will say Shopify is, well, I would have always said Shopify was, for the most part, completely and totally bulletproof in terms of account closures. Although they've started closing people's accounts in the last few months, I won't get into the politics of it, but it is, troubling to some degree that they are now evaluating sites on their platform and choosing to close people's Shopify sites. I honestly would have never, ever thought that would have happened, and we can debate the merits of that in a different episode. But nonetheless, omni-channel selling is less risky than single channel selling. And a catalog business with a lot of products, especially integrated products, is wiser than a single product business. Yep.
Yeah. I mean, I think what interests me is, I mean, first of all, we're talking very, very basic concepts, but they just generally aren't lenses through which people view Amazon in the way they might view driving or cycling. That there is risk, that we acknowledge it, that we calculate it, that we manage it well. So yeah, what interests me more, though, what's more exciting, is to figure out asymmetric risk reward, because what that means is you can actually get a lot wealthier a lot quicker whilst maintaining the same level of risk, which is very cool. So I know you got some fun examples here. Let's go through a couple of those.
Yeah, I think I've got a couple examples that are fun and point out the ideas here pretty nicely. One is, and I just tried to figure out in my own personal work right now, what is example of asymmetrical risk reward. And so there's a fun one here. I think most people won't be familiar with the back end of this tool or how this works, but I'll just share my screen for those that are watching live with us, and I'll explain it for those who are listening on the podcast. I'm currently working on the audio edition of my book, E-commerce Power. And that work is done through an Amazon tool called ACX.com. And so in ACX.com, as the author, sorry for the setup here, but I'll get to the asymmetrical risk real quick. For authors, here's what you do. You go into ACX.com and you tell them what book you've got to publish, and you've got two choices. You have a choice of paying a one-time fee for voice talent actors to read your book. So on a finished hour basis, like, if it's 6 hours, then you'd pay 6 hours of their time at a certain dollar amount. Or you can have a royalty deal with them. And this gets on the horns of the dilemma for them. and for me as the author in terms of the asymmetrical risk reward. It sets it up really interestingly because what's happening here is if I just share my screen and show it, here's a back end example for those who are watching us live. I set this project up so that I chose a fixed one-time payment from $100 to $200 per finished hour. It's a 6.5 hour book. So if somebody charges me $100 an hour, they know they're going to make $650. Now, this then is live for talent to start looking at and reading. And I have at the moment 150 people who have read 2 paragraphs out of my book, which I put in here, that they could read for me. And here they are. And I can play them. And, we could, if we were fancy podcasters, we could dub some of these in. It's just a hoot to listen to. And I chose not a young voice, not an old voice, but like a median age, middle age voice. And I chose either male or female. And so all these people started reading my couple paragraphs and giving me and submitting it. And in the tool, the way it works is I can favorite the ones I like. Out of the 150, I have 8 that are sort of my top ones I like right now. Now, think about the mathematics here for a minute. What these people are doing is they are saying to themselves, I'm going to spend, let's say, 15 minutes to read through this manuscript and do a submission of my time. So they're risking 15 minutes for the potential upside reward of, let's say, $600. So 15-minute risk, no cost. I mean, nothing else, no money is involved, and they could make $600. Now, if I would have changed the game and I would have made it a royalty-based arrangement, they would have done the same 15 minutes for the potential future revenue stream of some amount. Now, the future potential revenue stream, then they have to take a huge risk on me, my book, my ability to market, whether they think it's a good topic, a good manuscript. They're taking a huge amount of risk for future royalty. But think about it. What would happen if they paid, they got $600 payment for the one-time version, and my book goes on to be a New York Times bestselling book with 1 million copies sold? They would have lost out on a massive future revenue stream of royalty payments, but they would have had $600. But if my book is a complete dud and no copies are sold ever, then that $600 would have seemed like an amazingly wise choice. And this sets up the asymmetrical risk reward on their side. And on my side now, I'm on the other side of that equation, the other side of that gamble. If I get a New York Times bestselling book going here, and I've only ever paid $600 for the audio edition to be done, I literally then get, it's technically the math is 40% of the audiobook sales I get from Amazon for me completely by myself. So that's the example. I don't know if that sparks any interest or ideas there, Michael. But
I really like it. And I think what I like about non-directly normal, I'd say standard e-commerce examples is that it forces us to think about the broader concept and clarify the concept itself. Mm-hmm. Independent of a particular platform, which I think is really healthy. That's one of the things I hope we do really well here. At least we aim to. And I that really reminds me of the even for the authors themselves, letting go of royalty versus upfront payment for musicians. Like I got musician friends all the time who sign waivers saying, I will not claim my royalties. They sign them off. And there's this famous, there's a book called Birdsong. I can't remember who wrote it, very famous British author about the First World War. And it's called Going for a Song in the publishing world because he signed away his rights for, I don't know, a few £100 or a few $100. And of course, it became a huge bestseller. So it's, to some extent, we have to be wary of the sort of the one that got away, the fisherman's thing. And like, I had this really, really big trout once and it got away. I'm like, okay, well, yeah, I nearly invested in Amazon 5 years ago, but I didn't. That was really stupid. But hey, it's gone away. Let's not look back too far. But I think what you make the point about this, you could get the royalty, but it better be quite big to outweigh the certainty of payment now. So I would say money now is worth a lot more than money in the future. And you can do your discounted cash flow. That's kind of what discounted cash flow is about, right? What's the money of $100 invested in Amazon now? In 10 years time, you've got to account for the time, as you said. But the other thing is, that I think people really get this wrong with private label products. The upside potential of it would be pretty big. If a bird in hand is worth 2 in the bush, I think in private labeling and in similar product development, a bird in the hand's worth 5 in the bush. I mean, many of them will not take off the way you think that they will. And we get blinded, and we have to kind of get blinded when we're doing product development. We have to think this is the best thing ever. And when we're marketing it, we have to. But the truth is, the market may not agree. And therefore, we need to be very, very mindful about we don't even enter into a situation where the upside potential is not very considerable. It's no good having this mentality of an average product will sell 10 units a day and it will sell, 20% margin or something. No, I want really fat margins, and I want a really great upside potential, because quite a lot of them will sell 2 units a day and will make no profit.
Yeah.
So that's again, how it skews my thinking in a very real way. And I've got a story with the client, but I'm interested in your thoughts about this.
Well, I think at the macro level, the question is is entrepreneurship even a logical thing to get into? And is e-commerce selling even a logical thing to get into? And it goes back to this Robert Kiyosaki quote that I've used in prior podcasts, when he was asked, if 90% of businesses fail after 5 years, why in the world would you do it? And or something to that effect. And his basic response was, who cares? Who cares about that 90% failure rate? Because if I fail, I'll just start it again.
Yeah.
And so his logic there is, yes, you might fail 90% of the time, but if you can immediately start over, even if it took you 3 or 4 times, then you're evaluating the upside of a business compared to a 9-to-5 job. And the upside of a business is unlimited upside potential. That's the draw. And that's the draw for authors, for books. I mean, the magic of a book is, all things being equal, a few thousand copies might be sold on average. But there is always the story of the 4-hour work week, or the Harry Potter, or Richest Man in Babylon, which you quoted from. These books that then go on to sell 1 million copies, 10 million copies. I mean, do the math. It's a massive revenue royalty stream, and those install themselves. So then it kind of perpetuates once they're successful. That is the massive asymmetrical risk involved in an author's life. I'm going to invest 3 months to write a book. I may make $0, and I've lost 3 months of my life, but it could be unlimited upside potential. And that's the draw for authors.
For you, man, you're totally bewitched by this. I love the passion for this authoring business. To bring it back to a bit more to the sort of everyday world of e-commerce. I mean, just to preface I counter your Kiyosaki quote with a Bezos quote. I mean, and by the way, I love that Kiyosaki quote. You're absolutely right. That's bang on. Bezos said something a bit more sobering, like, okay, if you have a 1 in 10 chance of 100xing your investment, you should always make that trade, but statistically you will fail 9 times before you get that. I mean, whether it's the first time or the 7th time, also, we don't know. If you toss a coin, it won't necessarily come up heads, tails, heads, tails. You might get 8 heads. And if you were betting on that event, which I don't advise you to do, you would feel pretty horrible if after 49 some freak event happened and you had 19 in a row where they went wrong. So this is the nasty downside reality that we have to get our head around and learn to live with and survive. But here's an example in the private label world of, I'm actually implement this stuff. This isn't just theory, as you said. This is very, very, very practical. I'm working right now with a client who's a startup, but I'm still trying to find more sophisticated philosophy than I used to. So instead of going to China and ordering a load of stuff, I've tried to bake this into the whole model. So I've said, right, let's try and find some products that we can order that handmade. The lower order quantity means that you don't have to bet thousands and thousands of dollars on being correct based on your research, and product research also doesn't just mean keyword research. We do thorough job with the interviewing potential prospects and deep diving into it. But nevertheless, we may well be wrong. And I say, so instead of trying to be perfect about that, here's what we're doing. We're going to order 5 units, 50 units roughly, about the amount he thinks he can sell in a month, across 50 units each of 5 different variations of this product, different types of wood, different shapes, etc. Here's what my calculation is. If you can sell 50 units a month across all of them, then that's amazing. Now, that's the kind of thinking that a lot of people have. Oh, it will all work. I don't believe that. Now, if it doesn't sell at all, and you have to just destroy the stock, which is the worst possible downside. I don't think it's likely to happen. The biggest amount he could lose, so the downside potential, is 100% of his capital. So whatever that is, it may be a few $100 per set, maybe 1,000, maybe less, like a few hundred. The upside potential is if you sell those 50 units, yeah, you maybe go out of stock, big deal. You just order a 200, you ship them in, they sell, you order another 200, and over the course of 6 to 12 months, that's a real massive return. So, but what interested me about this situation, as I said, look, let's not obsess with the exactly precise keyword research, because the truth is, this is another topic. We don't get much data from Amazon, so we cannot be precise. A false precision is worse than none, because you think you're going to be right and you're not. Let's acknowledge that we're not going to be right. Let's set the situation up so that the biggest downside is 50 units worth and the upside is unlimited. And, 1 in 5 taking off is a pretty good odds. And I think that we've done good research as well. So I'm pretty excited to see how that pans out. And this is my new philosophy for working with products now. I don't want to try to be correct on one go. I want to set the situation up such that if I'm wrong, then the downside is known and limited. And if we're right every so often, the upside's really big, and that I don't have to be right all the time, and neither do my clients. It takes the pressure off as well. So I think it's just so practical and so immediately important. It's not just an abstract idea.
Yeah, no, and what you're just describing there is portfolio management.
Exactly.
I mean, it's a portfolio approach to risk mitigation.
Yeah, exactly.
And that's absolutely one way to insure against a fatal downside. Yeah, is portfolio. That portfolio is an answer to a lot of people's problems in a lot of ways. I mean, you're spreading a risk across multiple options instead of one option. Yeah. No, totally love that. Totally agree.
But I just want to capture, just to respond to that point. Yeah, it's not just about risk diversification. That's asset allocation, or that sort of way of mitigating risk. It's the asymmetricness that specifically is relevant to today's topic. The biggest amount you can lose if you spend $500 on 50 units, the biggest you can lose is $500. But the most you can make, if that takes off over the next several years, could be tens of thousands of dollars, or at the very least, even if it's a small market, several thousand. And therefore, it is not only diversifying the risk, but it's asymmetric as well.
Yeah, love that. More examples? Do we have time for a few more examples?
Yeah, go ahead. If you got some examples, I know you got a couple of things from Pixie Fair.
So I've got Pixie Fair examples. People might be tired of Pixie Fair examples. I've also got one that's outside e-commerce that maybe I'll mention this one just if it piques people's interest in terms of learning more and going and doing some research. And then if we have time, we'll get back to the Pixie Fair example.
Yeah.
Currently in the U.S. and I guess globally, the Spac investing topic is super hot. SPACs are special purpose acquisition companies. They're basically an alternate tool to an IPO where a company would go public. It's a way in which the company can go public, and it's a way in which people can invest. So you invest in something called a SPAC, and I got into these a year ago or more now, I guess more than that. And here's the interesting process in the asymmetrical risk nature of what happens. Somebody puts out a SPAC for you to invest in, and there's a lot of examples I mentioned, but let's just say it's out there and it's investable thing that you can put money into, and you put money into it generally at $10 a share is a common price, and it's a blank check company, as they call it. There is no operating business. It's just the shell of a checking account with, let's say, $500 million in the checking account. And you're investing in that, and you're, in essence, investing in the person who's sponsoring the SPAC. So you're really believing in them. So, for example, if Reid Hoffman, the founder of LinkedIn, a legendary Silicon Valley investor and co-founder of PayPal, if he creates a SPAC, you say, oh, man, he's probably going to do really well. And what he's doing is he'll get, let's say, $500 million or $1 billion, and then he looks for a private company, and he basically says, hey, private company, you want to go public? I'll give you this pile of money, you go public, and boom, we've got a publicly traded company. And all the people who invested in that SPAC then have shares in this new public company. Sorry if I said private, but they get shares in this company as it goes public. Now, here's the interesting part. Let's say I put $10,000 into a SPAC, Reid Hoffman's SPAC. I don't know what company he's going to go find and take public. but I know the terms of his deal. He has 36 months to do it. And if after 36 months, and you can go look up all your details if you want on your own, this is just a rough generality. After 36 months, if he does not find the private company to take public, the money comes back to me as an investor. Now, here's the interesting asymmetrical part. Where in the world can you invest that much money for 36 months with the promise that if something amazing happens, you get an upside, or if just, the normal process, you get an upside. But if something, like if it does not work, they just refund your money to the investor. That is not a common investing scenario, because usually in an investing scenario, you're putting all your money at risk. The $10,000 you invested would go to zero if the venture fails. So this whole new thing that, and if you research this, if you've never heard of SPACs before, go research it. Look at CNBC and their reporting, or some online educational sites. The concept there is new and it's intriguing. Richard Branson took Virgin Galactic public with a SPAC with Chamath Palihapitiya, who was the SPAC sponsor, and it's done incredibly well. And so some of these lose money though over time once they go public and the new company is out there for people to invest in, but some of them do exceptionally well. So it's another example completely outside of e-commerce of having money put up for a duration of time and then evaluating what's my worst case scenario and what's my best case scenario, and then making a decision in that regard. So hopefully that's not too abstract a real world example, but there you have it.
Very interesting. I do feel we should probably bring it back to e-commerce in a second, since we have the words in the title of the podcast. But I think it's very interesting. I mean, I guess that the only thing I would say about all that stuff, if I'm going to play devil's advocate, would be what about counterparty risk, which is something else that is very relevant to e-commerce. For example, counterparty risk means something like I give my supplier $10,000 in the expectation of giving them $20,000 and receiving my goods in a month's time. In the meantime, they go bankrupt. Okay, that's called counterparty risk, as I understand it, unless I've got that wrong. So I suppose there could be counterparty risk that Reid Hoffman's little SPAC or big SPAC maybe blows up in the meantime. But I do take your point that getting your money back if nothing good happens is somewhat more, certainly more asymmetric risk reward than you would get investing in say a stock, whether that be Shopify or indeed your favorite Tesla, which I have to confess as well, I'm also an investor in now. I don't think it's relevant to our podcast in case it becomes relevant. So I think, again, bringing it back to e-commerce, I'd love to get your Pixie Fair example. I don't think we should shy away from your personal experience, but what I'd love to say at this point, before people's brains shut with a clang because they're busy e-commerce operators, I just think that the conceptual level stuff, but which is very robust, simple, and visible in life everywhere all the time, in business life above all, is something we need to grasp as a concept, as well as finding applications. And I think if you trust that the concept's valuable, then you can find your own applications easily in your own business life. But if you reject the concept because it's not appeared on an Amazon webinar near you or something, then you're missing out big time. I mean, SPAC is a special example of a particular way of implementing a very valid general principle, I think. That would be my thoughts. So let's talk about Pixie Fair, because obviously it's your business. It's definitely e-commerce. I'd love to hear about that, your example.
Yeah, we run a marketplace business. We're in essence a digital publisher, and so we have about 115 brands that we publish on Pixie Fair, and they are basically constituted in three fashions. One is our in-house brands that we personally did the work to create, and there's a catalog of digitally downloadable patterns that we've published that we've made. The other category is royalty partners that publish with us, and they get a royalty payment, a future payment based on sales we make. And then the third bucket is in some occasions we'll just buy people's catalog for a one-time price, and then we have it, and we don't owe them any further obligation. We just wrote them a one-time check, and we get all future sales ourselves. So that it creates different scenarios, but I'll just talk about the most obvious scenario, and that's this idea of whether we have a future obligation to a royalty partner or not, and whether they uh, what they would prefer. Now, it's interesting because let's say somebody's spent, a month working on something, and I say to them, I'll give you a certain amount for it, one-time payment, or we can publish it as a royalty agreement, and it might take 3 years for you to get to, that number I was offering you, or 2 years. They have a choice to make. What do they value more, cash or time? Oh, the potential of long-term cash over a decade might be 2, 3, 4 times higher, 10 times higher. Who knows? But that, in my business, that's literally what we're doing all day long, and that's created a catalog of about 3,000 digitally downloadable patterns, and that's how we think about it. And we create a scenario in which there is no win-lose. It's win-win. It's just a question of what's preferential to people. Is it preferential to people to have upfront money quickly, or is it preferential to have more money over a long-term period? And here's the specific application to every single e-commerce business. Anything that you look at in your business, it's an ongoing expense, like a commitment that you make. You can always ask the question, how can I zero out this ongoing obligation? Is there an alternate way in which I can zero out this obligation? And if you zero out that obligation, you're adding equity or value to the assets of your business. In essence, you're creating a scenario in which your cash flow is going to improve over time.
So basically, if you agree with somebody that you're going to pay them over time, then you don't have to pay them up front. Then your cash flow is just much
diminished.
better.
Well, it's diminished on a monthly basis.
Yeah.
But if you say to them, I'm going to pay you one time for this,
Yeah.
and it's a number, it's a big number.
Yeah.
But as soon as you recoup that, it all falls to the bottom line. It's like buying the real estate. Like, so another example is the real estate underneath a restaurant. The restaurant owner can never buy his real estate and always pay a lease. In any business, is true. This is true for any business. Or you can say to yourself, I'm going to buy this building, and it's going to cost me money, and it's going to be painful, and it might be a multi-year process. Maybe it'll take me 20 years to pay it off or whatever. But when I pay it off, that monthly amount is going to fall straight to the bottom line. I'm going to put it in my own pocket and not have an obligation. That thinking you can apply across the board in any expense category in your business to figure out asymmetrical risk opportunities.
Very interesting. Yeah, funnily enough, this is very relevant to e-commerce because quite a few people I know actually run their own warehouses, which is a heck of an overhead, but has many upsides, and it showed up in 2020 as being that flexibility and bypassing the FBA system particularly. And one of the guys revealed that I think his family's been renting warehouse space for generations. I mean, they don't own it, but they've been in it forever, which is crazy.
You want to have one other fun little twist on this is Amazon. We all know Amazon's most profitable business category.
Yeah.
It's AWS.
Yeah.
And what did Amazon do? What was Amazon doing there and the guy who actually built AWS is now the CEO of Amazon. So the guy who had the smartest thinking, Andy Jaffe, I think his name is Jaffe.
That's it. Yeah.
Funny story about him. We'll mention in another podcast at some point. There's just a personal connection to that. But here's what he was doing. He looked at Amazon's probably largest expense, and this is 20 years ago, 15 years ago. And he said, how could we turn our largest expense into an asset? And it was the server capacity and the hardware, computing power. And by offering it to other companies, they created a tiny little revenue stream that probably for the first few years didn't even come close to underwriting any part of that business. But as they went to scale, they got to the point where other people's use of their servers not only paid for Amazon's server costs, it became a massive income generating part of their business, to so much to the extent that now it is the primary net profit generator inside Amazon.
And by the way, this is a slide note. It's not to do with risk reward, but it's a pricing, which is don't try this at home, folks, because this is not a pricing strategy I would advocate to any small business owner. But basically, Jeff Bezos, being the thrifty guy he is, and also super smart about competitive practices, said, I'm going to make this so damn cheap that it is not attractive or even doable for Microsoft or Apple or anyone else into that arena.
Google, yeah,
which is why or Google indeed. So AWS has really cornered the market, and not massively cornered, but it's got a huge percentage of market share of the sort of server and sort of the other things that they offer, the computing services platform, essentially, including the CIA, I understand. So there are a lot of serious players on it. But they deliberately priced it so it was unattractive for the competition. That's sophisticated stuff that requires huge capital. This is why I'm saying don't try this at home, but it's interesting to observe the dynamics of that, right? That everything those guys do is just super strategic. It's just they are super smart people. And as you say, Andy Jassy coming in kind of is it's kind of a signal that AWS is coming of age. I mean, the interesting thing is, this is a complete side note, but very relevant to Amazon sellers and particularly investors in Amazon. Okay, if AWS is forced by antitrust legislation to split out from Amazon.com, how does the retail wing survive on its own? Because economically, it's not that self-sustaining in many ways.
I never thought of that before.
It's going to be very interesting times for Amazon shareholders. This may be the time to get out. I didn't say this. I don't give investment advice, particularly not on air. But anyway, I don't know.
Yeah, don't do that.
We ought to sort of summarize this together, because there's been a lot of big points. But let's pull this thing together so people got some takeaways and actionable things.
Here's my summation. As an e-commerce operator, we all need to be looking for opportunities to risk a small amount to gain a large upside, and look at our large risks and figure out how to minimize or reduce them so that we move outsized risks to asymmetrical risks that are more tolerable to us, and constantly move to a position where we're making small bets with big upside potential. And we become more and more clear on the future vision related to those small bets, because the more we know about our short-term actions and activity, the less they seem like risks. They really do move from being a scary risk that we don't know what's going to happen with, to just a simple investment that you know what your machine will perform an outcome for. It becomes more algorithmic. And get clarity on executing our business models, so that we move into this category of finding asymmetrical risk opportunities and really investing in them to leverage huge upside potential. That's my summary.
That's huge. I got a couple of things. I think you mentioned the time element of things, which I think even for the humble sort of startup, even if you've not got huge money, I think if you put the right time frame on things, you look at things completely differently. If you're obsessed with this ludicrous idea, may I just put this out there, that please don't do this at home. If somebody says you can replace the day job within a year, run the other way, please, because it's rubbish. I mean, it could happen, but the probability is extremely low, and you'll start taking ridiculous risks. But if you put a 3-year frame on something and look at the risk reward ratio in that sort of frame, or even a 10-year frame, if you start 6 different businesses up, as a Kiyosaki would have us do it, then I think you make very, very different decisions. The time frame you put on your decisions is just monstrously important. Jeff Bezos wins. One reason he's done so well with Amazon, famously, he thinks in 7-year chunks, and the markets on Wall Street tend to think in quarterly earnings chunks. That's a huge competitive advantage. The other thing I would say, in terms of small big bets with big upside potential, I totally love what you say about having a machine that can make things more calculated than scary kind of uncertainty of risk. Nevertheless, you can engineer, even with new, brand new to a market, not sold anything yet, if you work with the right people, which I have done with this client I've mentioned, you can engineer that situation from the very beginning. You can build it into your way of operating. If you take it to heart, it really will change everything. I think it's such a critical concept. So I'm a big fan. I'm biased, but I think it's just fascinating. And very, very interesting stuff today. I like it. Thank you for the discussion.
To just underscore that point related to coaching, I hadn't thought of it that way, but an investment in coaching is an investment is tapping in tapping into other people's understanding of the business models that you're running. So if you find a private label expert and you're investing in coaching with them, obviously what you're doing is you're investing cash to mitigate your downside risk. Hopefully, ideally, if they're a coach or a consultant that's worth their, salt. And so that's the idea there with working with experts. It really does give you an opportunity to spend more money on the front end, but potentially not waste time and not waste money in the long term. Yeah.
Yeah, that's absolutely right. And that's the point I made to somebody the other day, and he didn't go ahead with coaching. And I kind of feel like, yeah, that was the right outcome because
Yeah.
he was starting from scratch as well, but he'd been probably fed some slightly more optimistic, rose-tinted view of Amazon.
Mhm.
I said, well, look, can I give you certainty? No, I can massively reduce the downside potential, and I can increase the probability of success. And nobody at that level, if they've been fed the sort of Amazon
Shiny
juice,
object.
they
Mhm.
don't like the word probability, yet alone risk. But
Yeah.
if you are willing to acknowledge the existence of risk and that we live in a probabilistic, not certain universe, which
Mhm.
is very entrepreneurial kind of courage, if you like, the willingness to look uncertainty in the face,
Yep.
it's the specifically entrepreneurial thing, then that makes sense. If you believe that the world is, I do A, B, and C, and my master's told me, and then it will all just happen, then that isn't even an argument for getting a coach. It's just like, oh, but is that how the universe works? That's not what the guy on the webinar told me. I'm like, well,
Yeah.
this is my perception, dude, you know. So
Yeah.
I think if you're grown up enough to acknowledge the risk, then somebody can reduce your risk has huge value, and
Yeah.
something that can increase the upside has huge value as well.
Yeah. Totally agree. Love it. Well, if you're interested in this topic, of course, go back and listen to our prior episode about e-commerce first principles, and then stay tuned for additional episodes related to first principles thinking and how it can apply to e-commerce businesses. So with that said, Michael, thank you so much for another fun conversation. Let's end it here. And if you're listening on Spotify or Apple podcast, whatever your favorite listening device is, we'd love your highest review, rating, or feedback, and really appreciate it. Thanks so much.
Thanks, man.
Okay, great. All right, that's the podcast. Good times, good
Yeah.
times. Great stuff, man. Wonderful.
Yeah, fun. Nice to knock it around. I forgot about that Kiyosaki quote, and it's
Good quote.
so I can tell your current obsessions. This is an e-commerce podcast. You talked about Spac and then a book. I'm like, okay, let's bring it back to your website. That's an e-commerce website, but it's all the same kind of thinking. I don't kind
I
of.
know.
I'm not violently disapproving. The thing is that we talked about very many, very, very specific e-commerce examples, but
Yeah.
it's good to give a spread of stuff.
Yes.
And I think the property or real estate examples are always good because a lot of people have experience of that either
Right.
through their own residential property or they've
Yeah.
invested, and they're
SPACs
quite
are pretty out
concrete.
there. Yeah.
Yeah, Spike's
Oh,
pretty
you know
out there,
what?
but it's interesting.
You know what we
I'm
could have
interested.
done? Here's what
Yeah.
we should do. Okay, we're gonna have to do another episode on this. We could do an episode that's all about Shopify apps that create asymmetrical risk reward.
By the way, we're still live, dude. This is all going out to the
I
Facebooks.
know. I mean, like,
Yeah, we're
to the
okay with that.
people
I'm
who
just
are
checking. Yeah, yeah.
not in
So
the
we're just
podcast
sharing our process
listenership,
with
but
everyone here. Yeah,
no, yeah. But
yeah,
we totally
absolutely.
should do another episode, and that would
Yeah.
be a great because there are a ton of apps that
Mm.
you spend $9 a month on or whatever. But if they unlock a stream of engagement, revenue, whatever, so I could make a whole list of them, and so that would be a really fun set of examples as well.
Yeah,
So
for sure. Yeah,
future
definitely.
episode. So
Yeah, definitely.
awesome.
I mean, I think what's
All right. Well,
interesting
thank
is
you for.
yeah. Sorry, I was going to say to try and just apply these concepts which are more typically talked about in other arenas and bring it back into the e-commerce arena.
Yeah.
But yeah, anyway, yeah, fun as ever. I enjoy this stuff. As you said, the microeconomic stuff. Here's what I think. There's just so many easy wins, actually. If you're prepared to apply
Mhm.
it to everything in your business, one concept applied across your
Yeah.
business could change everything. Just one.
Yeah.
They're really super powerful. They're like Swiss Army knives, I think, for businesses.
Yeah.
So
Totally
this
agree.
is a great set of content. I'm really glad we're doing it.
Awesome. All right, man. Well, wonderful time. Thank you if you were listening and watching with us live. Really, really appreciate it. Feel free to leave a comment, like, love, whatever. Share this if you're watching it on our YouTube channel or on our Facebook pages, and we'll go from there. And of course, all of the prior episodes are available on the ecommerceleader.com. It's a great place to go check out. So, all right, Michael. Good times.
Take care.
Talk soon. Yep. Bye.